Are more U.S. jobs good for the stock market? Seems like an obvious answer, but isn't one as we get into what is June's employment report. Today on Macro Money. Welcome. This is Ilya Spivak, head of global macro here at tastylive. And it sounds like a fairly obvious answer here. Well, of course, more jobs is a good thing for stocks, you might say. More jobs is more money in people's pockets. That's more consumption. Consumption drives growth in the U.S. That, of course, drives corporate earnings. Surely this is good news. Well, maybe not in the near term. There's a certain sense of occasion here around this June release. This is the first time that we are going to have a piece of truly top tier, truly hard data after almost a month of hawkish posturing from the Federal Reserve, starting from the mid-June policy announcement where Jay Powell at the press conference said that policymakers are talking about a matter of years before they consider cuts. Then repeated much of the same the following week in congressional testimony. Then went to the ECB forum on central banking and turned up the heat some more on the following week thereafter. So this is the first time that we're going to see a piece of data weighty enough, front of mind enough to really test what the markets think of all of that and how they will respond, how that rhetoric has tuned their reaction function, given what the Fed is saying. So what we're going to do here is we're going to look at what this June report is expecting to deliver, and then we're going to break down some scenarios and say, if the market reads the data like this, then this is likely to be the response from stocks. And if the market reads the data like that, then that's the response. And then hopefully, once the data is out, the response is seen, we can get a sense for which world it is that we are in, and perhaps that can be our guiding light for how to interpret economic data in the coming months and what it's likely to mean for the remainder of this narrative, at least for now. So let's begin with what is actually expected to cross the wires here. You can see the monthly change in non-farm payroll is expected to come in at 225,000. That's just about the bottom of the recent range. The lowest number here would be 217. That's about 3 months ago. And so you would be looking here at something that speaks to job creation not necessarily falling off a cliff, not necessarily looking terribly weak, but toward the bottom of the recent range of values over the past, let's call it, year and a half to 2 years. On the jobless rate, the situation even more reflective of idling, coming down from 3.7 to 3.6% there. That's very much within the 3.4 to 3.7 range that we've occupied really since about 12 months back, maybe a little bit longer. So the expectations are not pointing to anything terribly out of consensus, terribly out of step with what has been the case for the better part of a year. That much, I think, is clear. Now, U.S. economic data has tended to outperform recently relative to expectations. So much so that this Citi Economic Surprise Index marching higher as it is after breaking through its 20-day moving average. Incidentally, as we surmised some weeks back might happen here on Macro Money, that index is now at the highest since about March of 2021. So we are looking at U.S. economic data that is outperforming economists' baseline forecasts by the widest margin since before the tightening cycle started. Speaking to a U.S. economy that, for lack of a better term, feels hot, feels buoyant, at least relative to the economic models that the lion's share of analysts are looking at. The expectations that this is benchmarked against are gathered from a wide spectrum of market watchers, buy-side and sell-side economists, strategists, analysts, which typically are aggregated by the likes of Reuters, Bloomberg, etc. And what we're looking at then is those folks' models appearing much more pessimistic than reality suggests, or that reality has verified. Reality has ended up being far less downbeat. And when we consider these expectations in that context, we are left with the sense that the risk of a surprise higher on some of these key measures, be it non-farm payrolls, be it the unemployment rate surprising with a lower number, that is a stronger labor market, that seems like an outsized risk. That seems like a greater risk than the alternative. The ISM numbers that we got this week tell a similar story. Consider here just even looking at the employment component of manufacturing and services. Services, of course, overwhelmingly the lion's share of who hires workers in the U.S. And you can see, although manufacturing employment slipped back into contraction territory in June, service sector hiring actually accelerated. In fact, accelerated to the highest in about 3 months. And of course, that's where most workers are. So the story of employment in the U.S. after these ISM numbers appears to be of impressive resilience. As we discussed in exhaustive detail on Macro Money yesterday, and you can, of course, see that video for that deep dive, this is in essence the problem that the Fed faces. Because if you look at the breakdown in the components of inflation, goods inflation over the past year and a half has been squeezed down to a very small contribution to the overall pie. Energy is at this point a disinflationary force. Food inflation is a relatively small wedge in the story, and with some of the recent market dislocation around sugar, which in large part had made soft commodities diverge higher, whereas other commodities mostly went lower over the past year. Seems like that soft commodities rally really has been the reason for food inflation being as sticky as it is, but that perhaps is now on the wane because those shortages in the sugar market look like they've been addressed. So the main story is that big, dark wedge that is services excluding food and energy. And of course, as we just saw, that's where the hiring is. And it is, in large part, why the Fed has an issue. Because if we look at what's going on in labor markets, this is really the last bit for the Fed to solve. That goods inflation has been squeezed to very little speaks to the mending of supply chains and the reduction in shipping costs post-COVID, and speaks likewise to the slowing of global demand and global economic activity thanks to the Fed's tightening efforts. Global trade volumes are significantly lower and inflation is down with them. But not quite as far as the Fed would like it to go. In fact, inflation expectations have tellingly stopped falling, whether we look at the short-term inflation swap market or the break-even market. And the last bit to do appears to be what you see on the screen here, addressing the supply-demand mismatch in the labor market. And since you are not going to magically create more labor supply, at-scale human cloning is obviously not something that anybody's looking at as a real solution. Neither is ramping up efficiency gains from AI in the kind of hurry that the Fed would need to get to its inflation target on time, if for no other reason than sourcing the raw materials for all the processing power needed to do that would be problematic on a short timeline, simply because there's just not those resources available, especially in an era of receding globalization. And so what you end up with then is this supply-demand mismatch in the labor market feeding inflation, and the only way to address it looking like it's going to have to come from the demand side. Since you're not going to make more labor in a hurry, the way to get this mismatch addressed is perhaps to reduce demand for the labor that's there, thereby reducing upward pressure on wages, and with it, inflation in the service sector. Now, needless to say, from the Fed's perspective, the way you do that is with rate hikes. And indeed, if we look at the evolution of Fed policy expectations, what we find is that over the course of recent months, we have seen not only the unraveling of rate cut forecasts baked into the second half of this year. Those are the gray bars there. You can see as of May, giving us anywhere between 75 to 100 basis points in cuts between July and December. You can see those cuts fading from the outlook over the course of May and June. And now as we get into July, a bit of a perking up in the rate hike direction starting to occur. So the markets have ostensibly noticed that the problem the Fed has is solved by more tightening, or at least the hope for solving it is in more tightening. And so rate cuts are almost certainly not on the menu for the back half of this year. Meanwhile, a lot of the risks that led to that tightening being there remain, but a lot of the reasons for that easing in the back half of the year, those have receded. Notice that going into late February, early March, we have a run-up in policy expectations, a narrowing of rate cuts in the back half of this year, and then a crash. That, of course, is the SVB-led banking crisis, and then a slow rebuild once it starts to look like that banking crisis is moving to the back burner. It becomes a little bit harder to get things off the ground through April because, of course, we still have the overhang from the U.S. debt ceiling debacle, but over time that fades too. And so now we've essentially come back to where we were toward the beginning of the year. looking at the overall layout here, it looks like a rate hike is fully baked in for one of the next Fed meetings. So by September, a hike is already in the outlook. You can see in the implied rate delta column for September, we have a net change of 29, almost 30 basis points from the current market by then, which means that at least the one regular size 25 basis point hike has already occurred. The probability that it will occur in July here looking like 89% with 22 basis points out of the 25 already in the forecast. We flirt with the idea of another hike, perhaps, in November, December. You can see the likelihood of one in November seems to be about 48%. So if you look at the number of hikes, cuts column, you can see in November, one hike is fully priced in and about 48% of a second one is there. The implied rate, though, 37 basis points, not 50. So that tells you haven't actually priced in the full two hikes. And then as we look out December, January, March, May, you get a kind of higher for longer sense where you give away this hike that we're about to see, perhaps by around March, May, and you start to see the possibility of real cuts on net as relative to where rates are now. So not just erasing this next hike, but actually cutting relative to current settings by about July, September of next year. So the market's seemingly saying it will be a year from now, give or take, before we see rates lower than they are currently. That's the backstory. So let's say, in fact, we get jobs data that endorses this view of things, that things come out better than expected. What is that likely to do in markets, given these moving parts? Well, one way to look at this is to say, what have the markets been doing as these rate hike expectations have rebuilt over the past 4 months? Here you have the OFR Financial Stress Index. That's from the Treasury Department. It measures credit market stress. And you can see here, it, of course, spikes with the banking crisis as Fed rate hike expectations shift aggressively lower. And as you get things calming down, that financial stress index does not really perk back up. So even as rate hikes come back into the outlook, or at the very least rate cuts come out of it, and we've almost now retraced all the way back to where the peak was back in late February, early March, markets don't seem particularly stressed. They don't seem to be reliant on those cuts existing in the outlook to feel good about financial stability. You can see that play out in spades, looking at how that rebuild in expectations has looked relative to stock markets. In the blue there is the S&P E-mini future. There's that rebuild in Fed policy expectations. You can see stocks have been going higher as the rates outlook has become more hawkish once again. So plainly, the markets don't seem worried. One way you could then say you could have a response to better than expected U.S. jobs data is to say, oh, well, good, stocks are going to like this. And yes, it probably means that the Fed has to be more hawkish. But But it also means U.S. consumers have more money. It also means that perhaps they can deal better with inflation because they're employed and have income and are able to stomach better an increase in the cost of living that comes from stubborn inflation and a rise in borrowing costs that comes with the Fed's response to that inflation. So perhaps we get more of the same. Perhaps we get higher yields. Perhaps we get stronger stocks. Might even get a stronger U.S. dollar around those higher yields because the dollar would become more lucrative to hold relative to other currencies and that it would confer more yield if the Fed were to be more hawkish. So indeed, if we get a good jobs number, maybe stocks don't flinch. On the contrary, the evidence over the past several months would suggest they might actually go higher. That's one perspective. Here's another. And of course, in the event that the numbers do disappoint, as we say, that's a possibility, though it doesn't look like it's the likeliest one. Well, then you would expect the flip side. You would expect Fed policy expectations to cool some, but then, of course, you wouldn't expect stocks to like that if this is what continues as we see it here. But it need not necessarily. Let's take a longer view here. What we're seeing here is the evolving relationship between stocks and the Fed policy outlook. And the S&P here is in the yellow. The sort of dashed line there is just a simple 5-day moving average to give a general sense of direction that's easier to perceive. And the main takeaway from this chart here seems to be that, indeed, over the past 4 months, the erasing of rate cuts from the outlook has come alongside rising stocks. So as the outlook has gone from more dovish here to less dovish here, stocks have gone up. That is as distinct from what happened here when the outlook was getting more hawkish last year, stocks were going down. When it stopped getting more hawkish, stocks were able to rebound. When it started to get more hawkish again, stocks declined. That dynamic pointedly changed with the SVB banking crisis and the aftermath. So can we bet that this will be the way this works? Well, maybe, but maybe not. Notice that what this has amounted to is more like a reset of this decline, a panic drop, almost erased, and still not quite yet. We're still not quite setting a higher high on the rates outlook. It's still not the case, all these months later, that the markets expect to see, even in the face of all this economic data doing as well as it is, a higher Fed funds rate at the end of this year than they expected to see in February at the end of this year. And what that suggests is that the rise in stocks here from these bottoms in February through to now, this move right here, it's really been less about the Fed is becoming more hawkish and more about risks that might have made the Fed more dovish are going away. This is not so much hawkish progress as it is resetting after panic. We still haven't made a higher high. But what happens if we do? What happens if we get such a strong jobs report that that red December 2023 line actually goes north of the peak that we saw 4 months ago. Well, that now would be a truly tighter environment. And truly something tighter than we'd seen before, not just recovery from worries about risks that haven't materialized, at least so far. Nothing is to say that we're not going to have a return to the regional banking crisis after all. It hasn't been addressed legislatively, so the risks remain. And the debt ceiling situation is as ever unresolved, but at the very least, we don't have to think about it until after the 2024 election cycle. So perhaps that's off the board for now. But let's say we set a higher high on this. Well, then we indeed are looking at a more restrictive policy setting, even relative to these unrealized risks falling out of the outlook. And then perhaps we really do get concerns about recession and over-tightening. And we get back into a dynamic where higher for longer, as inspired by a strong jobs report, becomes a reason once again to be fearful about the business cycle, to be fearful about risk assets and risk appetite, and perhaps then you return to something more like this or like this. Well, one might say, sure, that's a cute story and all, but why would that happen? But why would things change? Well, looking at the response to the generally better than expected economic data that we saw just today, ISM services, of course, front and center, but also the ADP employment report, which is a kind of guesstimate at least the direction that NFP might take, jobless claims, a variety of things. The response is really unmistakable. There goes the 10-year yield, there goes the 2-year yield, and there go December Fed funds rate expectations. Better data gives us a spike higher on all three. Now look at the response. Stocks go lower. Gold goes lower. That part, not shocking. Needless to say, a non-yielding anti-fiat asset doesn't do well in an environment where yielding fiat assets go higher. And in the green there is the euro, which might as well be the US dollar upside down if what you're looking at is the dollar index as benchmark. It's mostly euro, and the euro is the dollar's most liquid counterpart. So here we're looking at the dollar doing better as the euro comes down, and that being a liquid enough expression that it makes a statement about the dollar more broadly. So as we get expectations for more tightening in this environment, given how far we've come and how close we are to setting a higher high, the response is once again risk aversion when we get to a higher for longer sort of reading on the economic data. So if, in fact, these NFP numbers come out stronger, it could be that the response is actually negative for stocks, negative for gold, positive for the dollar, as opposed to what we've seen in the past 4 months. And the key touch point here may very well be setting an actual higher high on rates and really seeing the markets begin to price in a higher for longer world in earnest rather than just the fizzling away of episodic risk. Now, of course, in this environment, if the number is in fact worse, that would actually be better for stocks, perhaps in a counterintuitive fashion, at least in the near term. And that is macro money for today. And for the week, we will come back next week as usual, Monday through Thursday, right after overtime, which is a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, covering each day's events and how they might be interpreted and what might follow. I'm on with Chris again on Fridays for Futures Power Hour, as I will be tomorrow, to dissect what these NFP numbers actually do. And then on with Tom and Tony for First Call on Sunday evenings as the markets come alive for the week. Outside of those shows, I'm opining on Twitter at Ilya Spivak and writing for tastylive.com. Thanks very much for joining, everybody. Good luck out there. See you for Futures Power Hour tomorrow. Macro Money will be back next week. Godspeed.